If you live in New Jersey, New York, California, Connecticut, or any high-tax state, the government just gave you up to $30,000 in deductions back. The SALTCap, the limit on how much state and local tax you can deduct, just quadrupled. Here's what it means for your next tax return. SALT stands for state and local taxes. It's the total of two things, your state income tax and your local property tax. Before 2018, you could deduct the full amount on your federal return. If you paid $12,000 in property tax and $8,000 in state income tax, you deducted the full $20,000. Then the Tax Cuts and Jobs Act capped that deduction at just $10,000, regardless of how much you actually paid. For families in high-tax states, that cap was devastating. The One Big Beautiful Bill changed everything. Starting in 2025, the SALT deduction cap jumps from $10,000 to $40,000. That's $30,000 in previously locked deductions, now available again. If you've been paying $20,000, $30,000, or $40,000 a year in combined state income tax and property tax, you can finally deduct most or all of it. This is the single largest tax relief for residents of high-tax states in nearly a decade. Let's walk through a real example. A New Jersey homeowner earning $200,000 might pay $16,000 in property tax and $12,000 in state income tax, $28,000 total in SALT. Under the old $10,000 cap, they could only deduct $10,000. The other $18,000? Gone. No benefit. Under the new $40,000 cap, they deduct the full $28,000. At a 24% tax bracket, that's an extra $4,320 back, just from the SALT increase alone. For higher earners in the 32% or 35% brackets, the savings are even more dramatic. A family paying the full $40,000 in SALT could save over $10,000 in federal taxes compared to the old cap. Here's where it gets strategic. The standard deduction for 2026 is $16,100 for single filers and $32,200 for married couples. Under the old $10,000 SALT cap, most people couldn't beat the standard deduction even with mortgage interest and charitable donations added. The math just didn't work. But now, with up to $40,000 in SALT alone, the equation flips. Add mortgage interest, say $15,000 a year, and charitable donations, and you could easily exceed the standard deduction. If your itemized total is higher, you itemize. If not, you take the standard. The key is to run both calculations. For the first time since 2018, itemizing is genuinely competitive again for millions of homeowners in high-tax states. Not every state benefits equally. The biggest impact falls on states with the highest combined tax burdens. New Jersey, New York, California, Connecticut, Illinois, and Massachusetts. These states have both high income taxes and high property taxes. A homeowner in Bergen County, New Jersey, might pay $20,000 in property tax alone. In Westchester County, New York, it could be even more. For residents of states with no income tax, like Texas, Florida, or Nevada, this change has minimal impact since their SALT totals were already well below the old cap. There's one important limitation. The $40,000 cap applies in full only if your modified adjusted gross income is $500,000 or less. Above that threshold, the cap begins to phase down. For married couples, the phase-out starts at the same level. The higher your income above the threshold, the less SALT you can deduct. Very high earners may see the cap reduced significantly. Timing matters. The $40,000 cap is effective for tax years 2025 through 2029. In 2030, unless Congress acts again, the cap reverts to $10,000. That gives you a 5-year window to maximize this deduction. If you're considering major financial decisions, like buying property in a high-tax state, the SALT window should factor into your planning. 3 steps. First, calculate your total SALT, state income tax plus property tax. Second, compare your itemized deductions to the standard deduction. Third, if itemizing wins, switch your filing strategy this year. The window is open. Use it.
Money Unwrapped. See you next time.